Hi folks, Craig the Options Linebacker here. This is the weekend report for Sunday, October 10th. We're going to start off this weekend's video by looking at the Dow and the transport charts. The reason is because this is the Dow theory pair. We have the industrials building the product, we have the transport shipping it, and when they're both heading in the same direction, then we have a primary trend. And we certainly have a primary uptrend here with the Dow showing higher highs and higher lows. And very close, just a couple of days work from being able to hit the April highs. Same thing on the transports, and the transports are showing higher highs and higher lows, and that is a confirmed primary uptrend. And notice also on here that there is a lot of ink given around the early part of July about things like the death cross, which is where the 50-day moving average crosses underneath the 200-day moving average. And notice how on the Dow that's crossed back to the upside again. Nice fake out so far. Notice also in the transports that we never really did get the downside cross. There was just a couple of days there in early September where it looked like it was trying to cross, but we had that massive higher low at that point, and now we have the higher high, again very close to April highs. Now the bears can deny it as much as they want to, but it's plain right now that we are in a primary uptrend on all of the charts. So let's look at the S&P 500 and see where the rest of the market's going. We're going to start out with a monthly chart on the S&P 500. I'm going to say the same thing that I've been saying now for months because we have to remain consistent on this so that we don't get surprised that the monthly chart is still in a primary downtrend. We go from a higher high to a lower low to a lower high. That's still a primary downtrend. All right. So with that in mind, you can see why it's so important that the S&P closes this last few points here between 1165 up to about 1220, which is another 55 points on the S&Ps. What will happen at that point now, since there is potentially a higher low, is that if the S&P gets above 1220, it'll be a higher high up here. Then we have a change of polarity. No longer will we be in a longer term downtrend. We'll now be in a longer term uptrend. So you can see how important this is, and there may be a lot of battles going on right in this area. Probably over the last 2-3 months of this year, we're going to see a lot of volatility around this area. I don't think it'll just blow straight up through there. I think it's going to have a little bit of a war getting to that point first. You can see on the weekly chart of the S&P that this was such an important point here back around the beginning part of September, because the S&P had double topped there and looked like it was rolling over into that lower high and into a continuation of the longer term monthly downtrend because it hadn't made a higher high up here. That was the chance for the bears. They couldn't close the deal. If you go back to the late part of August, early part of September, there was just an awful lot of thrashing around. Down in this area, the bears could not push it down below July lows, and certainly not into a new level of fibs down here with beyond the 38.2% fib, which is where we finally bounced in the early part of July. So this is the turning point that was so important here, which could show that we have a change in polarity on the monthly chart. Now we certainly have a change in polarity back to an uptrend on the daily chart, and also now, as you can see, on the weekly chart. Now the reason why we're going over this in so much detail week after week after week is because of the fact that we don't want to get bull colored glasses, if you will. If the chart fails at this point below that 1220 level, then the longer term monthly chart influence will kick into gear again, and we could see a very, very quick drop back down to one of these areas here. Bullish sentiment is certainly rising now, especially after we got above 1130. Now we'll go down to the daily chart. Again, the sentiment is rising, the sentiment is improving, but it hasn't got to the point yet where the charts are just totally obnoxiously bullish. This is a good place to point out the 4 phases of a market rally. It starts with phase 1, which is disgust. And disgust is what we saw with the market around the latter part of August, where everybody was just looking at this thing going, you know, we tried to rally up there. It double topped at this 1130 level, couldn't get above that. for the most part, most people felt disgusted with this market. The second phase is disbelief. They can't believe that the market's actually rallying. And in fact, this is where a lot of bears will lose their lunch because they keep trying to short it at higher levels, saying, okay, this is just going to turn down here, but it just keeps backing up on them. The third phase is actually called acceptance. Acceptance is, I think we're just about at that level now where people are saying, you know what, the market is going up. It's not going down anymore. It's certainly going up. And that phase should have kicked in after 1130 was tested from above and held strongly and now appears to be lifting higher. Fourth phase is euphoria, and we'll recognize euphoria when we start to go parabolic here as the final bunch of shorts finally cannot take it any longer and start to cover their positions. That's where we start to attract new buyers off the sidelines, and then all of a sudden when people quit shorting the market every day, we're going to run out of buyers. And we're going to have to make a quick dip back down to support to attract those longer term buyers and reestablish the uptrend. So those are the four phases of a market rally. Again, I think we're in acceptance phase right now. Now I've got a 10-minute chart of the S&P futures up here, and I want to show you something that I'm seeing every day now with regularity. And this reminds me a lot of what we saw throughout 2009 and the first quarter of 2010, is that we would start the day normally with a little bit of a gap up, and then we'd see traders jump on that gap up and say, okay, let's go bullish, and all of a sudden they get taken underwater. And then that would attract some new weekend bears to short the market, but by the end of the day it would recover. And we saw the same thing here. In fact, here is 3 days in a row. We'd have a quick pop up and then all of a sudden take those guys underwater, and then before the end of the day, we're closing higher. Same thing happened on Friday. Quick pop up, take them underwater, and then a relentless short covering grind through the end of the day. This is exactly the type of intraday price action that we saw through the majority of 2009, minus any little corrections that we had. That's the character of the current market that we have right now. And we can either start with a gap lower that turns into a short covering event, or we can start higher that attracts weekend bulls. They take them underwater, and then we end up closing higher. The same thing is happening day after day after day, and people are falling into the same trap. Now, what is going to happen is this is going to change one of these days where we start moving lower and it doesn't stop. And this is where we'll have one of these scary 20-point pullbacks on the S&P when we start getting a little too euphoric, start getting into that fourth phase of the market. Now we are out of all of our October cycle positions with the exception of one small swing trade, which has got half of a position left, and we're playing that long currently right now. However, we've already started November iron condor positions, so we've got a nice position up here well above current resistance. So this is what I like to do. And this is a bear call spread, so as long as the position closes November underneath this area here, we're in good shape. We also have a bullish position way down here. As long as we get to November expiration with a price well above this position, we're in good shape as well too. So I expect to see, if we are going to have a rally from here, it's going to be very similar to what we saw throughout the first quarter, kind of a grinding affair where it sort of self-sustains itself and doesn't require any pullbacks as long as it continues moving like this. Strap on tight for expiration week, folks. We'll catch you next weekend. Take care.